Hello, everyone. Welcome to our term sheet masterclass. I'm Sara Lila Cordero, Business Development Manager at Endeavor Miami. The main goal of our masterclass is to share valuable knowledge and valuable information to support the knowledge of the entrepreneurs and their scale-up journey. And we do this by picking the brains of our amazing mentors from our mentor network. Today, we're going to do a masterclass on term sheets. We found that it can be sometimes confusing to negotiate and sign a term sheet for entrepreneurs. We do this masterclass especially with the help and the support of our partners. In this case, today we have Ernst & Young, also known as EY, and Dell for Startups and Dell Technologies. I want to welcome to the virtual stage, Sylvain Dominici and also Marcus Devane. Sylvain from EY, Ernst & Young, and Marcus representing Dell for Startups. Marcus is business development for Dell for Startups, and Sylvain is partner at EY. So Sylvain and Marcus, do you want to share some of your thoughts and words for the audience here learning and wanting to learn about term sheets, in this case with John Kim? Marcus, do you want to start?
Yeah, definitely. So first, I just want to thank everyone being here today, and welcome to this series of masterclass. And also want to thank the Endeavor team for putting this together, as these masterclasses just add value to the entrepreneur and startup efforts that they are pursuing. So the Dell for Startups program, we're here to help your business scale from any avenue that we're able to help, whether that's for discounting, for technology, mentorship, and then we also have free IT consultation that we're able to help you out with. For any questions or anything, you can reach out to myself at marcus.devane at dell.com, or reach out to dell.com/startups for more information.
Thank you, Marcus.
Yeah.
Thank you so much for joining and for your support on sharing our vision also and supporting entrepreneurs in their scale-up journey. Sylvain, do you want to share some words?
Sure, thanks, Sarah, and welcome everybody. So I'm Sylvain Dominici. I'm a partner at EY. EY is a consulting organization that helps clients with complex matters, from financial engineering to digital strategy and everything in between, while also making sure that our clients and companies or private individuals comply with legal and regulatory requirements, such as tax law, accounting, or audit, things of that nature. EY has been a great supporter of entrepreneurs for over 100 years that we've been around. We've got several programs to help our entrepreneurs and also recognize our entrepreneurs. We have a program called the Entrepreneur of the Year, which has been around for over 36 years this year. And we're very, very proud of that program to help entrepreneurs get the recognition they need. And so we are also a great sponsor of Endeavor. We love this organization and everything Endeavor does. So thanks for having us today. I personally sit on the side of EY that helps clients buy and sell businesses, so through deals. And I will tell you guys, you are in for a treat today with John Kim, a very experienced deal maker. So I hope you enjoy and learn a lot today. Thank you very much.
Thank you, Sylvain, and thank you so much, Marcus. Also, our two main partners to make these masterclass possible. Thank you, Sylvain and Marcus.
Thank you.
This is what we do at Endeavor. We partner to have a bigger reach and a bigger impact with organizations that share our mission and vision on scaling and supporting high impact entrepreneurs. Now, we're going to get to the main goal of this masterclass. John Kim will share their best advice and practices on how to sign a term sheet and important things to take into account when negotiating term sheets. John Kim is the managing partner and co-founder at Datavest Partners, an e-commerce buyout firm. Prior to co-founding Datavest, John was a managing director of HID Capital for 18 years, the leading technology and buyouts investments. He served on boards of e-commerce brands and digital marketing companies. Before this, John worked 10 years in various operating roles in technology, e-commerce, and software consulting companies. John has a master's and bachelor's degree and honors in industrial engineering from Stanford, and also an MBA degree with distinction at Harvard Business School. So John, welcome to the stage.
Hi, everyone.
Thank you so much for doing this for our network, openly sharing such valuable information for our entrepreneurs and followers out there in different media outlets. John, are you ready to start and share your screen?
Yep, happy to do so. Yep, great.
Wonderful. And everybody enjoy, take notes, and I would encourage to ask questions, and we will be bouncing these questions with John at the end. I will leave you now the stage for you to start. Thank you so much, John.
Great. Hi, I'm John Kim. I'm leading this class on term sheets. Just wanted to talk to you about, the first thing is just a little bit about my background. I think we went through that already, so I won't spend too much time on it. I'll say that I've done buyouts, I've done growth equity deals, and I've done venture capital deals as on the investing side. In addition, when I was on the operating side at tech companies, I did work at sort of over 5 years at startups, and we received term sheets on that end. So I've received term sheets, given out term sheets, and worked with companies to help them grow. So I feel like I've seen a lot of different sort of scenarios and cases, and each of these term sheets are different. And part of what we'll do today is to just go through not only the structure of a term sheet, but also some of the nuances with respect to what to look for and what options are out there for each of the main categories. I'll first say that I'm not a VC lawyer, and I'll kind of recommend that you get a competent, experienced, and expert VC lawyer to help you out when you do receive a term sheet, to help you with all the details of it. And I want to kind of give credit to NVCA, which is the National Venture Capital Association, and Foley and Hogue and Top Tool Finance. I did use some of their materials as part of this presentation. Be happy to kind of talk to you about some of these things a little bit later on. So I say that just the next area is just the scope. So I did see that in the Endeavor archive, there's a great sort of investor relations fireside chat. Jackie and Sanket did a really nice job of talking about how to find the right investor, what to consider in your pitch, like what level of diligence happens, like what is the process for raising money, how to get the right meetings, like the right intros to the right investment decision makers. So if you're looking for more of a broader scope about the whole financing process, I would encourage you to go to that sort of fireside chat. My topic today is going to be tightly focused on term sheets because that's the topic that I think a lot of you have expressed interest on. And based on the poll that you gave out, Endeavor gave out, I think the questions have come up with, what are they? What's included? How do you really review them? How do you think about valuation and how to manage that among the investors that you talk to? What are some of the things that you do with respect to the best ways to negotiate? And then finally, how does this term sheet impact future sort of fundraising and future sort of things just due to the precedent that you set with this term sheet? So that's the scope and the background. I'm going to spend most of my time on what are the components of a term sheet, and maybe a little bit later on about the negotiation and sort of the impact. Because I think a lot of the questions that come up is a term sheet is a pretty complicated document. There are a lot of terms in there that may not be familiar unless you've done it a number of times. And so excuse me as I go through this. Some of it will be familiar to some of you because you've seen them and you've worked through them. Some of them will be completely new, but there's still a lot of different nuances and flavors and styles and types and options here. So it's worth discussing. So the first question is what really is a term sheet? I'd say that it's really just a written summary of the most important key terms of the investment. It's really non-binding other than the fact that there is one section there that talks about confidentiality and no shop, which is not talking to other investors once you sign it. Other than that, nothing else is binding, although you expect that if you agree on certain things in the term sheet, it's going to make its way to legal documents. So you are expected to follow what you agreed to in the term sheet. So it is like a blueprint for how to lay out the major terms in the future legal documents. Remember that the investors can influence these investments far longer than just the check. And so the term sheet is really a guide on what you need approval for, what can be blocked, how the economics work. And so the term sheet helps to clarify a lot of that influence. And then just like when you're working with people on giving them job offers, term sheets are, process of negotiation. There's a little give and a little take. You've got to listen carefully to what the other side's saying with respect to what's important or not. And you just want to have a healthy discussion about that, because having a healthy discussion upfront, kind of clears sort of misunderstandings and misinterpretations down the road, and that you're aligned for the long haul. Because once they become an investor and you've gone through the negotiation stage, then you're you're on the same team, and you want to be able to make sure that alignment is there. So what are some of the things you do to be prepared in advance of negotiations? I think one of the things that's important is that for you and the management team is to really work out how you think about, obviously, what the ownership percentages are now, but then where do you want to really end up afterwards? And if there's going to be any sort of rejiggering or shifting of the proportions among the management team. Maybe you had some early people that contributed a lot early, but you have more of a different management team that's going to take it to the next level, and you might want to change the percentages to reflect that. And then also importantly is the vesting component. I think investors are going to expect you to have some vesting component. A lot of times it's just time-based over, say, 3 to 5 years. Sometimes it's a combination of performance and time-based, but you should get a sort of alignment on what you think is fair and what works for you. And that, because that's something that's going to be coming up. I say that the most important thing is that don't go to one type of investor or one investor, two investors. Like, keep it as broad as possible, because by keeping it as broad as possible, you're going to get a lot of different points of view with respect not only to the terms, but especially on the valuations. And you can think what you believe with respect to valuations, but in the end, like the market will speak, and it will give you a sense of what those are. The more people you talk to, the more data that you'll have. Remember, due diligence is a two-way street. Talk to other founders that have raised capital from the investors that you're talking to. You can ask for references, and they expect that, so don't be shy about doing that. At the right time, you can ask them about how the negotiations went, if the legal documents ended up any different from the term sheet, any surprises that came afterwards. Obviously, all the questions about what's it like to work for them and how much value that they really bring. But all those things are important, and you shouldn't be shy about doing the diligence on a two-way basis. And then finally, get some good advice. Like, obviously you work with your VC lawyer, but to the extent that you trust other former founders, entrepreneurs, or mentors, or other people in your network, it's always good to get advice on things, not only to explore the different options, but get a better sense of what's market or not market, kind of where things stand today. The term sheets in 2022 are very different from the term sheets in 2021, and you definitely want to be able to compare and contrast some of the things that may have changed based on current market conditions. So remember, we talked about the term sheet is just a high-level negotiation. It's much easier to negotiate the high-level terms in a term sheet rather than trading legal documents that are 20 to 50 pages long back and forth and redlining and those words there. So that's why it's a lot more efficient that investors are wanting to get all those big high-level topics negotiated and kind of agreed to in advance. There are other major legal agreements, and the charter, the stock purchase, the voting, the right of first refusal, the co-sale, investor rights, indemnification, and others that form the backbone of the actual binding legal documents that you'll adhere to afterwards. But that comes later, after the term sheet has been negotiated and signed. I always like to point out that the NVCA has a great sort of page where you have standard templates for term sheets and model legal documents. I encourage you to go look at them, download them. You can use that as a basis of comparison. It's generally the terms that are currently in market, or they'll give you different options of where it could be, and it just gives you a sense of what these documents look like beforehand. But obviously, if you're working with a VC lawyer, they should be able to help you through this process. So there's 4 main areas of a term sheet. There are the offering terms. There's the charter, which is the certificate of incorporation. That's the main legal document that govern how the company is kind of structured and run. There are investor rights that the investor is going to want with respect to how to help govern the company. And then there are voting rights that come after that too. So each of these different areas not only help define the parameters of the investment, but it helps define, and it's important to discuss, because you'll see as we go through this that there are a lot of different options, and you want to make sure that you're aligned with this going forward, because it's important to not only understand those options, but these form the precedents for future rounds. So what I'm going to do here is that on the right-hand side, you're going to see the actual NVCA standard term sheet template language. I'm not going to go through that all in detail, but hopefully we can share this afterwards so you can see that. And then on the left side are some of the points that I want to make about each of these sections. I'll go through the major sections, and then I have a couple of slides on some of the remaining terms, but it's just a way for us to help guide the discussion. So the first part of the term sheet is what I call the intro paragraph, which is talks about that this is the only thing that's binding is the no shop confidentiality. No shop really means that once you sign this term sheet, you can't talk to another investor about raising the money. If they inbound, you can't talk to them either. It's important for the investor to feel like they have a period of exclusivity to do the final due diligence, as well as just to finish the legal process. And they don't want to spend time and money doing that if they feel that you're going to shop it around and do something else. So that's important. And then there's a confidentiality provision where even mentioning the terms of the term sheet, or that you have one, that's important too. So the only 2 things that are binding are the no shop and confidentiality. The rest of it is just, as we talked about, the basis of negotiation, and we'll go through these in detail. The only other part in the intro paragraph to keep aware of is the question comes up is, where is it governed by? Is it governed by Delaware, which is the most common state because of the case law developed for venture-backed businesses are the most formed there? Or is it the company's headquarters or the VC headquarters? And you'll see different numbers there based on kind of which legal documents govern your company, as well as where the VC prefers to kind of operate. So that's the intro paragraph. The second part is the section on what type of security. Is it A, B, or C? Is it the first round? Is it a seed round? Is it the later rounds? And whether it's a different round that has usually different characteristics, as well as different sort of, we'll talk about senior liquidation preferences, or whether it's an extension of the same round that you previously did, because it's going to be roughly the same terms and valuation. It's just opening up to more investors, and maybe that's an A1, for example. The closing date defines exactly what is the expectation on when the deal will close. It defines exactly how long the remaining due diligence, as well as the legal documentation, is going to be. I would say that, as with everything in life, things always take a little bit longer. So always try to think about internally that you're going to pad a little bit there, but you definitely want to hold the investor to the fire with respect to trying to meet that date. And then the closing conditions are just kind of there, but it's really mostly legal. I mean, that's something that your lawyers will deal with. It's not that critical that we talk about this now. They're pretty standard, and it's really more lawyer to lawyer dialogue. The next section is what we call the investor allocations and amounts. So the question that comes is like, is this led by one investor and that's it? Are they taking the bulk of the round? Are there other co-investors in there? Are you going to leave it open to different additional investors down the road with, roughly in a short amount of time, anywhere between 1 and say 6 months? It's just setting that expectation up front to really define what is the total round size and whether this is going to be split up and by how much and like what's to be expected there. Because usually you get a term sheet from the lead investor, to the extent that a co-investor is identified, they're on this too. But like I said, you might want to leave some open if that's a mutual agreement by both sides. And then finally, the composition amount. A clean round is if you have just one amount that is done for this one. Sometimes companies have like a bridge that they raise from either previous investors or through angels and or the founders that converts into this round, and so that is also defined there. And then the investor will say, okay, well, that bridge can convert, but here's the dollar amount that it converts at. It could be the principal amount, it could be the principal amount and interest, or it could be a fraction of that, depending on what the competitive situation is and how much they feel like that bridge round was done time-wise relative to this round. So that's just kind of this section. The next section is the whole valuation. So pre-money valuation is exactly what you think of, which is pre the investment. So which is like how much is the company worth before the money goes in. Post-money is really just that pre-money valuation plus the amount invested. And then there are some equations that are used to try to determine what the price is and what gets sold. But I'd say that the key to really think about here is really obviously the pre-money valuation. We'll talk about in a little bit. There's a lot of different ways to think about how much your company is worth. And then the post-money valuation determines what ownership percentage your investor gets because they're putting in a certain dollar amount relative to the post-money valuation total. So in terms of managing valuation expectations, look, there are a lot of different ways to think about valuations. Comparables are really the most common way. You have a certain business, try to think about what's the right closest company, whether that's through precedent transactions or are there public companies that are similar to you out there, and whether they're revenue multiples or EBITDA multiples or gross margin multiples, like trying to figure out exactly what those multiples are and then applying those multiples to your numbers. And that usually helps to find the valuation. But sometimes it's just like you work backwards and say, hey, the investor likes to write a check of 5 million, or they like to write a check of 20 million, and then they like somewhere between 5 and say 30%. And based on how you rejigger how you think about check size and ownership percentage, like that becomes the evaluation. That's not as grounded into the comparables analysis. So there are a lot of different ways that it happens. In the end, the market valuation is really what you get from investors or one investor. That's kind of market terms. I say the one thing to keep in mind of, and we'll talk a little bit about this later, it's not always best to think about getting an outsized valuation at the early stages because you're supposed to hit value inflection points along the way in terms of future financings. And if you get too ahead of your skis, if it gets too high too quickly, you may risk a down round, and a down round isn't good for your investors because they're gonna not feel good about the momentum. They're not gonna feel good about the dilution that they're taking in. So bigger isn't always better. I know that as founders and entrepreneurs, you're always motivated to give away as little of the company as possible, but it should be managed in a staged way to be able to make it work for everybody as you go through different sort of financing rounds. One thing that's in the pre-money valuation is what we call an option pool. So the question is, and the option pool is really the shares that you set aside that can be bought by employees, consultants, board members. And the pool is really the aggregate amount of those options that are out there. The question is what does the option pool look like for you today? Have you used them all up? Do you have some left? You in a discussion with the investor are going to say, oh, actually, I think I need to increase the option pool size to like 5, 10, 15, 20%. And by doing so, and since this is baked into usually the pre-money valuation, it means that the founders are going to get less of the company afterwards. So bigger isn't always better. You should think about that, since in some ways it really dilutes you before you even take in the new money. So when you think about the option pool, I'm not suggesting you game the system, but don't be overly aggressive about that. You're only suffering dilution at that stage. Usually later on, when you work with that investor and you've shown good progress and you hit some milestones, they're more willing to take dilution with respect to increasing the option pool later. So it's not really necessary to be overly aggressive in making that too big upfront. Dividends. So what are dividends? I mean, they're like just kind of like payments or interest rate payments on the stock. I'd say that there are 3 different types. Dividends can be discretionary, where they're not really used until the business chooses to do so. And option 1 usually means that there are never any dividends. Option 2, which is like there are dividends, but it gets paid in cash, which is usually not the case because the startup needs the cash, or it is in stock. And then finally, cumulative one, where there is a guaranteed amount. A lot of times that in the past, it's hovered around 8%, and that just gets paid on to the preference as it goes up. So say that you invest 10 million, somebody invests 10 million, the next year that's worth 10 million plus that 8%, the second year another 8%. So it just accumulates. And to the extent that you have a liquidation effect where the investor is not converting into common shares, but there's a scenario where the preference comes into play, and I'll talk more about what that really means. It could mean that you have a building sort of interest, just like you have like credit card debt or mortgage debt that keeps going up because you're not really paying down any of the principal. So what is a liquidation preference? So liquidation preference is a situation where you have like a built-in sort of return for the investor, usually in a downside scenario. I use this champagne glass analogy because like it just means that as something flows in from the top, whoever has the most senior preference gets that sort of waterfall, that dollar amount from a sale. And then it goes to the next level and the next level, next level. And usually on the bottom levels are common shareholders. And the way it's structured is that it could be multiples like 1, 2, or 3x. It could be that these dividends that I talked about get tacked on. And so instead of like 10 million being the 1x liquidation preference for a 10 million investment, it could be more than that, especially it's over 5 years. And then the preference overhang is what we define as if you combine all the liquidation preferences across all the different rounds at the time you exit or sell, that's the preference overhang, which is like, if you think about it from a founder's or common shareholder perspective, it's really the aggregate amount that you have to pay out to investors before you get a single dollar back out as a common shareholder. Obviously, we're talking about situations where this liquidation preference comes into play because the company didn't do well as expected. Because if the company does well, the investors are going to make more by converting their preferred shares into common shares and participate by ownership percentage. And so, but these liquidation preferences are important sort of in a downside scenario. So we talked about the different preference types. There's what we call non-participating, which is like if you put in 10 million, the first 10 million goes out, but then if you sell it for 100 million and say that you give that investor 20%, they're going to convert it because they would get 20 million in that situation instead of the 10. There's what we call capped, which is like participating. We'll start with uncapped, which is like they get their 1x out first and then they participate at 20%. So in that scenario that that example that I mentioned, they'll get the 10 million out. since they own 20% of the company, they'll get 20% of every dollar after that first 10 million is given to them. And then capped is like they do that up to, say, a certain level, but then it's capped. And so remember that preferred investors, which are the VC investors or whoever's giving you this term sheet, remember that they always get the greater of this preference amount or what they would get in terms of if they converted to common stock. So obviously in a big upside scenario, they are going to convert to common stock because the dollars that have gone into the company are way less than the worth of their ownership percentage at the time of exit. But these preferences come into play in sort of downside or mid-case scenarios. So here's just a couple of graphical examples of what we're talking about here. If you look at the, in this situation, it's 20 million for 20% of the company. The first one in the middle, and the one on the left, shows that for a 1x at a, say, a $40 million exit, they get, you get the 1x back, and then you kind of get capped at that $20 million level. So that's why it flattens out at 20 million. And then on the one on the right, on the 2x, they get every dollar up until like 40 million, then they get capped out, and then the common shareholders like participate after that. It ends at 100 because since 20 million for 20%, after 100 they would convert because they would make more money rather than being capped by the liquidation preference amount. These are the three scenarios where we talked about full participation, cap participation, and non-participating. We don't have a ton of time to go into the details, but it shows you that there are different scenarios based on the cap nature and participating nature about what the proceeds go at different exit amounts. And so what I would encourage you to do is like run like a model and have different exit amounts. And based on what you negotiate or are negotiating with respect to whether it's capped or full or participating or not, see what the investors will get at different exit amounts. You can see where common shareholders get at different exit amounts, and just feel comfortable about that. A lot of founders and management teams feel really sometimes overconfident and say, hey, these preferences don't really matter. I know we're going to sell for 200 million plus in this example, so they're going to convert anyway. Why do I have to worry about that? Well, that may be the case, but it's always prudent to be able to think about downside scenarios and what this looks like. The one thing I would say is that I would overly caution you about negotiating this too much, because sometimes if you do it too much, then the investor is going to get a little warning signal and say, hey, why are they so worried about downside protection? They should be thinking about the upside. And so that's something that keep in mind, as you don't want to overly negotiate this part. So in terms of the considerations is that, remember, like this is going to be standard. You should think about how they interact, because in future rounds, you're going to be have different preferences for the different rounds that you have. And sometimes they are all aligned nicely. Sometimes you get some weird sort of flat spots or drastic jumps based on the way you've negotiated that. It's always good to set a model to that and see where those weird sort of points are. Remember that these early rounds set a precedent for later rounds, so don't get too greedy. So the investors might get too greedy, but they might live to regret it, because later on, the B and C and D round investors may want the same multiple. So then it just hurts them with respect to where they sit in that waterfall. And then finally, I would say that preference can be a way to bridge a valuation gap. So for example, you want a greater valuation, but then they were willing to give that to you if you give them a 2x or a 3x. But just keep in mind there are trade-offs on all of these things. With respect to voting rights, I would say that usually this section talks about that they want 1, 2, 3 board seats. It depends on what they're looking for. The question is like, how many board seats are there do you want in the company? I personally feel that smaller is better. You have more conversation, less coordination issues. The question is, what's the right balance between investors, founders, and sort of independents or outside experts? you might want to give away an observer seat rather than a board seat to help kind of nuance that a little bit so that you don't have a constantly ever expanding large number of board directors. Then think carefully about how it's defined. Sometimes it's defined as a CEO board seat. Sometimes it's defined as a founder board seat. There are differences there, and you want to think about that as well with respect to how long you want to feel involved at the board level. Protective provisions. So protective provisions are sometimes called negative covenants, veto rights, blocking rights. They're basically things that the company can't do without investor consent. And these things get highly negotiated. It can diverge from one round to the next. A couple of things that are important. One is that it's important to figure out what's the right threshold, because say that you have more than one investor per round, you have to figure out, like, do you need both of those investors to do the blocking? You only need one. If you have multiple rounds and multiple preferred investors, are you going to make those threshold votes by class or in aggregate? There are a lot of different ways to think about that, but those are situations that I think as you come across them, there'll be good discussion points that you have with your advisors and your lawyers. So I won't go through all these different sort of protective provisions, but they usually care about, one is like, okay, if there's another round, can they block that or not? That's obviously a big one. One sort of midpoint would be that they can block it up to a certain time period, but after like a certain time period, like 18 months or 2 years, then you can raise additional capital without getting their approval. Paying dividends is one where you have to get something where you want that to be decided in advance, but that's really not a big sort of talking point. They're concerned about adding debt. They want approval on debt. One thing that comes up often is really like some of them want to be able to approve compensation plans and option plans. You got to negotiate exactly like how much control or approval do you need there. And then like board size increases important to an investor because they don't want to, they think like getting 1 or 2 seats is important in a board size of 5 or 7. You can't arbitrarily increase it to 11 and dilute their influence. In addition, there's sometimes a board directors approval language. So there is another section that's not just investor based, but the board of directors have to agree on certain things. And sometimes it includes like the loan, indebtedness, sometimes includes approving the budget. But since this is board directors instead of just the investor approval, you should think about, okay, what is the composition of the board once again? Like, how much can you influence this? Because, this often comes up in the term sheets and you want to be able to negotiate what things you have to get approved by the board in terms of the threshold there versus like just making it a board vote. So anti-dilution is protection from investors on future down rounds. Like, for example, if you sold shares at a certain valuation, if the next round comes in lower, do they get additional shares to make up for the fact that they invested at a higher amount earlier? There are 2 different ways to do this. One is like full ratchet, one is weighted average. There are different ways to like calculate this. But this is an example of showing that there is different anti-dilution protection where the first pie chart says, okay, that's post-Series A. And then you see that based on the different sort of definitions, the owners of the business get different amounts based on the anti-dilution protection language. And so it is meaningful. Once again, I'd say that if you negotiate this too much, then you might raise a yellow flag with investors saying, why are they worried about anti-dilution for down rounds? So that's something to keep in mind as you negotiate things with the term sheet. With the term sheet, there's like dozens of things you can negotiate over. Like, I would just encourage you to focus on the things that are most important to you. And then the last couple areas is that there are other parts of the term sheet that are in that as well. The ability to like tag along to future sort of sales, the ability to buy shares in subsequent rounds. being able to like force shareholders to sell when you have a sale that meets certain conditions. You want to really focus on the right sort of thresholds there, and that's important. For example, like there are tough term sheets where if the board of directors decides to sell a company, then you might have the company sold, even though you might want to have some blocking power there. We talked about vesting. You got to think about that in advance, like how do you want to structure the vesting? And there's a section on redemption rights, which is the ability of the investor to sell shares or force a company to sell after 5 years. Never negotiate this section. I don't think I've ever seen this ever happen. So like I wouldn't focus in at all. And then just like 5 other sort of key points is one is that there are preemptive rights where the investor get ability to participate in future financings, make sure that's based on fully diluted ownership, not percentage of preferred, because that way you can bring in additional investors without having them take up too much of like subsequent rounds if that's kind of the desire that you want. There may be a pay to play where investors force each other to participate in, especially in down rounds, to give them incentive to come up with additional capital. And that's important to make sure that everybody's fully aligned. I'd say that information rights, registration rights are not heavily negotiated, and so it's not important with respect to the negotiation process. So how do you negotiate a better term sheet? Well, some of these are pretty obvious, but it's important to try to like do the extra work here. One is that talk to more than one VC and make sure that you keep them on the same timeline. You don't want to be a situation where one gets too early and another prospect's like just started, and you want to have everybody roughly at the same time. So don't like serial process your calls, like try to hit everybody all at once, keep everybody on the same timeline, because that competitive tension you get from multiple offers only happens if everybody's working on the same sort of process timeline. Once you get them to that they're interested, really do the work to make sure that they have the commitment, resources, the network, do the diligence that I mentioned before. Remember, it's a two-way street. It's a partnership. You're gonna be working with them for many, many years. It's important to do that work. That masterclass earlier that I mentioned has a lot of good comments there. Work with an attorney. Like I said, don't go through this alone. There are more nuances than I even mentioned in this short masterclass, so there's plenty more. I would say that, and then finally, I would say that, look, you're the face of it. I know you could use your lawyers to be the bad cop sometimes, but remember the investors are investing in you and the team, and you're gonna have to present that side and fight for what you think is important, and to really focus on the most high priority items. And so I'd say the last thing I have is really how do current term sheets impact future rounds? Well, as you do subsequent rounds, they usually piggyback off of the earlier terms. They always ask for earlier term sheets, so you're going to have to show them. Recognize that things generally get worse sometimes, or maybe they get better depending on the momentum of your company. But remember that you're setting precedents with your early rounds, and keep that in mind, not only for that round, but for future. Sometimes it's hard, I recognize, because look, you need to get a round done and you're willing to give up certain things, but they do have precedent effects. Growth equity is you may be able to cash out some and some sort of secondary transaction where you get some money off the table. So that's where growth equity comes in. There's certain flavors and how that structure works with respect to who gets the cash out and how to think about re-upping the option pool. And the IPO is sounds great, but they usually want founders and management teams to be locked up for a while, so it's not the liquidity event, at least immediately. So that's the end of the term sheet. I went through this pretty fast. Wanted to leave enough time to do Q&A. As you can see, a term sheet is pretty complicated. I only went through, say, the 2/3 that were really important, and then there's a lot of little nuances that come up in the legal documents, and that's best done through a lawyer. But hopefully I was able to give you some things to consider and how you should think about it. And once again, happy to answer any questions.
Thank you so much, John. This was amazing, very useful, a lot of details in such short time. And we do have some questions. Our marketing team will help us add them in the here in the subtitles in the bottom. Um, Here. Question 1 about valuation. At what point in the pitching raising journey should that initial outside valuation be done? That's the first question. And the second one, you mentioned the closest company and applying their multiples in the best guess effort. Does it matter how long that company has been in the marketplace? Extreme example. What if closest company is Amazon?
Yeah, I'd say that when you do a comparable based analysis, it's usually done as a multiple of, like I said, revenue or EBITDA on a close competitor or larger company, and you use like previous, say, transactions that got done, whether they're financing rounds, M&A, or like public events. There's usually some discount that you apply to that because you're not as big as them, so there's usually some discount there. But you're probably growing faster than them, so that I think that has to weigh into the valuation as well. And I would just, the key thing is to try to find as many companies as possible and do like top quartile, bottom quartile, like median, mean, so that you get a full range of that. In the end, you need as much ammunition as possible to be able to like talk to the investor about what you think the company is worth. And the more data that you have, the better with respect to arming yourself with that discussion.
Oops, I was on mute. Thank you so much, John. Just to confirm, do we have any other question? Is there a good standard option pool size? Does the speed at which you're growing makes a difference?
Yeah. So I think one thing to really do is like what I would call an options forecast. So an options forecast is similar to your revenue forecast or your P&L forecast, is to think about how many options will I need based on which positions I think I'm going to hire in the next 6 months, a year, 18 months, 2 years, 3 years, and say, okay, I need a CLO 1 year out. I need a chief of CMO like 2 years out, and figure out based on sort of what's market out there, like what they typically want with respect to ownership percentage, and start to bake that in and come up with like your options need by year. And then once you do that, you get a sense of, okay, if this round is going to last me 1 year, 2 years, 3 years, and then it goes into that sort of forecast, then you can see how much you need with respect to that option pool. And to the point, like if you are growing faster, then you're going to add more people, and then you'll need a larger option pool because of that fact. But it all starts out with an options forecast by title and by sort of the option package that you expect to pay that person.
Wonderful. There's one more question. Are there any resources you recommend for charting?
I'm not exactly sure what charting means. That could mean a lot of different things.
Yes, maybe we can ask them to elaborate more on that, as shown in the presentation.
I mean, I still I'm not exactly sure what the actual part in the presentation is, but like I said earlier, like the NBCA has a lot of resources. If you Google like SlideShare and VC term sheet, you'll see this resource of like 30 to 50 different presentations that talk about things you should consider there. There are a lot of like papers and white papers about how to think about that from lawyers and sort of advisors, and so there's a wealth of information out there. But in the end, I would still talk to your lawyer because your lawyer is going to be representing you, and then additionally, your network of people who have gone through this, right? They've gone through it, they've seen the different things, they know what to fight for, what things to prioritize, and what the trade-offs are, not necessarily at that moment, but probably more importantly down the road if they've done subsequent financings.
Great. Thank you so much, John. With this last question, that was a wrap. Thank you so much for your time. And one of the big takeaways, even if you go through this masterclass and you learn all of these details, it's so important to always have professional advisory and hire a proper lawyer for these negotiations and these processes. So we will have this masterclass hanging on the internet and on our social media outlets. And thank you so much, John, for your time, for enlightening us with your amazing knowledge and experience on term sheets, and for putting this presentation together for our audience. We have our next masterclass on November 15th. This series will keep on going with a masterclass on brand building, diversity, and race, also powered by Dell Technologies, from our mentor, Arturo Nunez. We will be keeping you posted on social media for the next masterclass, but again, November 15th. Again, thank you so much, John, and thank you everybody in our audience for tuning in on this masterclass on term sheets. See you on November 15th, and thank you, John, again.
Thank
Bye-bye.
you. Bye.